Good evening. Welcome to the big question on NDTV Profit. I'm Vikram Oza. The rupee has crossed that line, and it's not just another number on the ticker. Now at 91 to the dollar, India's currency has slipped to a lifetime low, which means it is down nearly 6% this year alone and now ranks among the worst performing emerging market currencies globally. It has been beaten only by the Turkish lira and the Argentine peso. So among the Asian peers as well, if you make that comparison, the rupee is at the bottom of the pile. So what you're seeing is not just a one-day panic. It's a slow grinding slide we've seen of the Indian currency. At the start of 2025, this calendar year, it was at 85 rupees and 64 paise. Now we've gone past 91 rupees today. So obvious question is, what is causing it? We've discussed the reasons earlier on this very show, and the reasons haven't changed. For one, the rupee has been driven down by the heavy foreign outflows. Then, of course, foreign direct investment, FDI. FDI has also weakened. At the heart of it, of course, could be the US-India trade negotiations. We don't seem to get closure on this. We don't know when it's going to happen. And that is putting the pressure on the rupee with the kind of tariffs that are in play. And then, of course, there are the intensifying global trade tensions, mainly led by the fresh American tariffs. So, yes, foreign investors, they've already pulled out nearly $32 billion from Indian equities this year itself. So considering all of this, many market watchers are saying that confidence in a swift market recovery, that is fading. And what's adding to the unease is the RBI's shifting posture. The Reserve Bank, on the one hand, has intervened. Like we've heard and we've reported, those OMOs, they've seen more dollars in the spot and forward markets, the open market operations. But also, the RBI is allowing more currency flexibility. So forward dollar liabilities have climbed to about $63 billion, which takes it to a 5-month high. Now, this is a signal that the RBI is smoothing out the volatility, as it were, on the currency, and yet it's not defending any particular level of the Indian rupee. In fact, even the IMF, the International Monetary Fund, has taken note of this shifting posture of the RBI and has reclassified India's exchange rate regime as a crawl-like arrangement. The IMF calls it a crawl-like arrangement. It is certainly a step away from the tightly managed rupee we've seen in the past. So the big question that we're asking tonight, is the rupee falling because India's fundamentals are under pressure? Or is it falling because policymakers are quietly choosing growth and exports and reserve conservation over currency stability? It's important to ask and know this because there are sections in the economy that may find a rupee fall useful. Again, we've discussed this. Exporters like IT firms, also those who receive remittance, they may cheer a weaker rupee. But then we have to understand the costs of a falling rupee. Those cannot be ignored. A depreciated INR means costlier imports. It means higher fuel, it means higher medical bills. It also means expensive foreign education and pricier holidays. And don't ignore how jittery this could make the equity markets. At 91 rupees to the dollar, the rupee is no longer just reflecting global stress, it's testing India's economic resilience and our policy priorities. Hence, we ask on the big question today, with the rupee at 91, what is really ailing India's currency? How much more pain on the currency front can the economy absorb? Let's get this discussion going with our panelists, and to do that, we've got an excellent panel. Anindya Banerjee is joining us. He is Senior Vice President for Currency and Commodities Research at Kotak Securities. Subramanian Sharma is also with us, Founder and Director at Greenback Advisory Services. Dr. Dipali Pant Joshi, former Executive Director at the RBI and a macroeconomic expert in her own right, is with us as well. Great to have you. And Madhvi Arora is here, Lead Economist at MK Global Financial Services. Thank you, ladies and gentlemen. Thank you for making the time. Anindya Banerjee, to you first. Now we are seeing the markets getting quite jittery. We've seen the weakness come through. But what are the markets seeing? On the currency front, what is the fear that they see? Is this about the external factors, or is this more about the internal factors that India faces with the pressure on the INR?
Very good evening, and thank you for having me. See, there are three kinds of factors which are right now plaguing the rupee. First, I would say the sentiment. Yes, the Indo-US trade deal, still we are waiting for a closure. That has hurt the sentiments. Second, what we are seeing is the flows, and the flows, as far as the FPI flows are concerned, it is now almost $3 billion outflows, and we are just 2 weeks into December, and this is the third largest outflow this year. And third factor would be the global backdrop. Because if you look at what is happening in the world markets, because of the rising US bond yields, because of the fear of the yen carry trade unwind, we are seeing a lot of pressure which is coming into risk assets. That is also accentuating the outflows, leading to more speculative bets against the emerging market currency like the Indian rupee. So all those three factors are coming in, and because RBI is not intervening aggressively because of certain macroeconomic reasons, we are seeing the rupee move in this manner and in this magnitude.
Manian Sharma, several factors, yes, but the foreign investors pulling out money from Indian equities, I'm just wondering whether they're doing it that much more because they're seeing the fall in the Indian rupee, or is the opposite true? Because they're pulling out, that's why the pressure is building on the Indian rupee.
See, basically, the rupee has seen no respite over the last couple of days. And if you look at from a technical perspective, yes, the weakness has been, I feel, more overdone, and mainly because of outflows. FIS, as you said, has pulled up almost $32 billion in the last 1 year, not only on the equity, but also from the debt. There's been a pullout. So now, which comes first, we don't know. But basically, at this point of time, India seems to be on the receiving end from all perspective. In fact, of the sanctions, in terms of the tariffs which have been put, the signing of the India-America trade deal is getting postponed. So a little bit of negativity has created, and that has resulted into driving the equity market weakness. And we have seen that there's no respite. And it has broken various technical levels. In fact, rupee is now trading in an uncharted territory, and we don't see it ending unless some big reforms or any change, major change, come from the trade angle, and also from FIS stopping their big sell-off. But fundamentally, if you look at that, I don't see any problem, because India has shown a very fastest growing economy at 8.2%. In fact, the November trade deficit has fallen by almost 18 billion, which is better than the October, which was at $41 billion.
Exactly.
The inflation at the lowest level. So fundamental is showing a different picture, and technical in terms of outflows is different picture. And till this outflow stops, and coupled with that, of course, RBI has also taken a little backseat in terms of the aggression in which they intervene, because in a outflow, when they intervene, it will not serve the purpose and it will only drain the reserves. So possibly they are taking a little muted approach to see when this stops, and then come at a time when the demand is stopped, and at that point of the intervention will be effective. So possibly, I think we are now at the fag end of the year. FIS may stop their selling by coming next week, and that could keep the rupee steady at this level. And whatever action happens will be in the new financial year, when we are closer to the budget, and if there's a pace of the India-US trade deal gets faster, and any talks on the tariff reduction comes, that could boost the sentiment, and the process will get reversed, and the rupee can see a correction. But yes, at this point of time, I think the free fall has been driven with all the negative factors which we have been saving.
Yes, these negative factors have been in our domain, and we have been trying to understand them. But Dr. Dipali Pant Joshi, what do you make of the dichotomous view that we are getting on the economy? Because at the one hand, we are looking at trade deficit data that came through yesterday, and it's looking quite strong. We are looking at US exports as well. What exports India makes to the US, that hasn't been hit substantially by the tariffs, despite that trade deal not being there. And yet, now we are hearing about the RBI from the last kind of monetary policy as well. They have decidedly taken this stance of smoothing out volatility. So those volatility concerns they are addressing, but they're not defending any particular level. Is that the right approach that the RBI should take looking at this kind of macro data?
No, absolutely, that is the right approach. The RBI will not allow itself to bleed in the market. It will not defend any. You see, if you say that I'm going to defend 92, then there will be a great rush to break that down. So the RBI, like any other central bank, simply manages and sees that excessive volatility is not there. There is a glide path. The rupee is declining. It's very great for our export competitiveness. And the only reason that the rupee is declining is good. it has something to do, of course, with the FPI outflow, but that always occurs towards the end of the year when they cash out, go away, and change their holdings of Indian equity, Indian bonds into rupees. We are not worried because our inflation is very low. So any action on their part of infusion of rupee liquidity does not impact us. That said, the second reason is that if there is volatility, then importers of oil, electronics, gold will rush for cover because they need immediate dollars for their shipments which are coming in. That again is not an issue. Whoever is unhedged with corporate debt hanging on them does not want the whammy to increase and is rushing for cover. That is also contributing to the fall in the rupee. Everybody has spoken about the elephant in the room. I'm not going to go there. I'm not going to talk about the trade deal uncertainty. All I will say is that the minute there is a resolution for this, please wait. There will be a very strong knee jerk reaction and a very positive a rebound in the fortunes of the rupee. Now, as far as the RBI is concerned, it has always got a hands off attitude towards the falling currency. It's just volatility. Volatility is par for the course. The market, the demand and supply will eventually settle down.
Right.
As of now, there's a higher demand for the dollar from the importers, from the exporters, from all those who are rushing for cover.
Correct.
Sadly, at this point, there are also leads and lags, because the exporters wait for it to decline further before they get their money in. And so that's the lag in the system. And the leads are the importers who rush at this point so that it does not fall further. So these leads and lags also impact the rupee. A strong US dollar index globally, and this is being supported by the Federal Reserve, which is just refusing to cut its rates and is keeping its rates very high. That is essentially what is weakening sentiment in all emerging markets because there is a safer haven in the domestic currency and the countries abroad. Now, this is something which is external to us. Our fundamentals are very strong. As I have said before, we are not in a currency crisis. We have very strong forex reserves. We have external debt which is manageable. We have got, it's a very different situation from the one you saw in the year 1990. And I could break down all the differences from 1990 for you. Firstly, your debt. Now your
But
debt
one sec,
higher.
Dr. Dipali Panjoshi, let me get in a perspective also from Madhvi Arora and let me come back
please,
to you.
of course.
But Madhvi, from your perspective, since Dr. Dipali Panjoshi has pointed out about the RBI's rationale in trying not to defend any particular level of the Indian rupee, but even having said that, 91 to the dollar is a level that we've never seen. Yes, we have good forex reserves. Yes, our trade deficit picture is looking quite strong. But are we saying that this is not something that affects us, whether it's on the inflation front, whether it's our growth momentum? How does it look for a government and the RBI to see this kind of fall on the Indian currency?
See, any kind of, policy intervention to save a particular asset class would have repercussions on the rest of the economy in some form or the other. It's the net cost that matters, right? Every policy action will have some, impact. But as I said, what really matters is that in the end, are you actually trying to reduce the net economic cost to the economy? At this point in time, I agree with Dipali ma'am that, to a large extent, what the policymakers are doing is neither a repeat of what you saw in the 90s or 2013, nor is it's particularly too wrong. Of course, there will be an inflation impact. There will be imported inflation. As you mentioned in the early part of your show, that it will lead to a much higher imported cost, or travel or even, global borrowings that you do. All of that obviously will have an impact on the global debt or the dollar debt that we have on our book. But beyond that, there will also be some kind of a financial easing which will come via a weaker rupee, which will, over time, if at all that continues to be the case and leads to productivity gain in the economy, would actually help us gain some trade pie as well. But that has to be seen because not necessarily would a weaker rupee will imply a higher trade share. But to a large extent, a part of this adjustment that is happening in rupee is required. For the last 5 years, if you look at, the rupee has been actually overvalued, as we all have been talking about. There's a catch-up that has happened. Currently, market is believing that rupee is undervalued compared to its fair value. If I look at the REER, and despite the fact that inflation has actually come off, REER still continues to be extremely weak. And I think to a large extent that is now perpetuating from a current account to a capital account, where the fear of self-reinforcing weakness in INR is leading to FPIs actually is exiting in the market. But I think the recent last 2 or 3 weeks also has, the year-end effect where FPI tend to sort of leave emerging markets and close their books. So I think I would still wait up for the next year to start, wherein we will get some allocation. 1 and 2, there could be some form of trade rule that could come by. It may not be a very fruitful one, but even if we get rid of the punitive tax of 50% to bring it down 25%, I think there could be some bit of a relief rally that you would see in the economy. But that said, any kind of policy decision would always have some economic cost. And, the net effect is what really matters.
So this economic cost that we're talking about and emerging markets, when you talk about the relative performance in recent times, because on the currency front, Mr. Sharma, we are getting clubbed with Argentina and Turkey, some of the weakest kind of links, as it were, when you talk about the global economy. So then if India is being pegged in those, does that reduce our macro credibility? And that's why it shows the pressure.
Because, India was normally compared with China and, normally other emerging stronger economies than Argentina and Turkey, which has always been weak, and their currencies have seen sharp depreciation. So I think that comparison doesn't hold good as far as Indian rupee is concerned. Indian rupee at the moment seems to have been singled out compared to other currencies. If you see the dollar index has fallen to almost 10 to 12%, and all the currencies in the basket have appreciated. Even other Asian currencies have appreciated. The yuan also has appreciated. So normally when rupee is compared, they also look at how yuan has been performing. So, at this point of time, the yuan has appreciated and the rupee has weakened. So it is purely a technical drive where the outflows have been more, and it has been much higher than in normal years. That 32 billion is not a small amount. So that has been the bigger trigger. And like Madam has mentioned that, the importers also are little bit of a panic. They are covering their exposures. Exporters are taking a backseat, waiting for better levels. So this mismatch has actually led to the rupee depreciation. But comparing to Turkish lira, I don't think, or the Venezuelan peso makes sense for comparison.
You don't think that's a fair comparison, but Dr. Dipali Joshi, even as we hear about this clubbing with other emerging markets and chiefly those who aren't doing great when you talk about economies, emerging economies at that, but still you have some appreciation coming through from the IMF. They are reclassifying India's exchange rate regime as a crawl-like arrangement. Explain to us how that should be read. Should investors look at this as a signal that policymakers are getting more comfortable with gradual depreciation going forward? But to what level then is the next question?
No, there is a glide path, as I said, for the rupee. And do not forget that oil is a necessity. Now, the oil imports have reached a 6-month high, as they were tracked to do in December. And we have to pay for oil in dollars because the discounts on Russian oil are also shrinking. Now, we are not impacted by what the IMF says because our own macroeconomic fundamentals are there. For all to see, our GDP growth is going to be 7.3%. We are a very strong country economically. We cannot be clubbed with Argentina or Bangladesh or, or Turkey, because look at the political turmoil in Turkey. Look at the political stability in our country. An investor also looks for two things. He looks for the ability to enforce contract and take his money back. We have no problems. You want to cash out and go, please go. We know you're going to come back because we have inherent strengths of the economy. It's good that the IMF is appreciating us, and naturally we are happy about it. It will also boost investor sentiment and make it very clear that this is just volatility which central banks manage. That's what they are there for, and they have reserves for that.
But
they have currency currency stabilization reserves also.
But ma'am, investors are not seeing it like that. Anindya Banerjee, perhaps you can tell us. Right now, we are seeing that kind of weakness seep in. So is the fear that this is going to translate into inflation for the Indian economy, like Madhvi was pointing out as well? Is that something that worries investors right now, the kind of pullout that we are seeing from foreign investors? Is that a problem area that they see that could I mean, it could kind of have a kind of effect that would see that much more being taken away from Indian equities in times to come? Is that the fear? And that if the RBI doesn't act right now as far as its decisions go in terms of its monetary policy or otherwise, then that investor sentiment gets dampened even more?
Yes, in the short term, see, markets kind of create a circular logic. A weaker rupee, so outflows can be high, especially from debt. Now we are seeing outflows in debt as well. And that triggers further weakness in the Indian rupee. So yes, RBI has all the wherewithal to intervene. But the question then comes, why isn't RBI intervening? And what could be the larger strategy? Because see, in the past, whenever we have seen a lot of talk about the rupee depreciation, the policymakers have issued statements. RBI has come in and intervened quite aggressively. I think this could be a strategy of the RBI where we have a higher real growth. The domestic economy is doing fine. The inflation is low. Crude oil prices are falling, about to go down towards, I think, the last to a 4-year low. So at this time, it is good to use your currency as a weapon because we are fighting a trade war. When the trade war happens, currency becomes a weapon. And I think this is a kind of a trade-off that the policymakers are doing. Yes, the investors, the speculators will be not happy with that because they have a more short-term kind of a perspective. But if I look at a little more medium-term kind of a perspective, the current situation where Indian rupee is an outlier, like you compare it with the Turkish lira and things. When was the last time such a thing happened? It was in 2013. Now, 2013, we had just exact opposite kind of a ground situation. We had absolute macroeconomic political instability. And on the other side, US had a very strong economy. The overall stability on its policies was there. Right now, just opposite. India has an ocean of stability. America is slipping into kind of a extreme instability with its fiscal policy, with its monetary policy, growth, everything. So I think this makes the rupee quite undervalued. And that's the reason why I think the policymakers are not so much bothered at this point. They are watching it, of course. RBI has the tools. So yeah, the in the short term, the speculators will not like it, but considering that it is helping the exporters, that may turn out to be a good strategy over the medium term.
So the speculation right now, Madhvi, is about the negotiations between India and the US, and that's turning out to be the overhang. But is this the structural overhang issue now, more than a diplomatic issue that the markets would be worried about? Do you think they're kind of imagining this as a structural problem, which could take the currency even lower in times to come?
Well, to some extent, yes, because, the trade deals have gotten dragged more than anybody would have expected, at least for India, which was seen as a neutral player in the geopolitics middle of this year. And in fact, the policymakers were also very confident that they would crack a deal with the US, and a deal which is much better placed compared to the Asian peers who were seen as a part of the China plus one leg. And the whole trade war actually started off to essentially break that China and China plus one leg of ASEAN economies. As we stand today, not only have we not gotten anything great from the US, we actually have been imposed with a much higher tariff than our peers. So clearly there is a relative loss of competitiveness in exports versus emerging Asia. While our exports have held up well compared to most of our expectation, let me add it that EM Asia also has an extremely well-known exports, largely led by tech exports. But even the Asian peers have not gotten hit on export front per se. In fact, their exports have actually been pretty strong.
Yes.
So from that point of view as well, it's all relative story in the end, both trade as well as currency. Their relative plays are not, absolute plays. So our relative loss of export competitiveness against emerging market Asian peers is basically also a function of higher tariffs, right, which in principle would warrant some adjustment via weaker currencies against our peers. So I think to that extent, fundamentally, such depreciation would actually act as an natural stabilizer, automatic stabilizer for a weaker current account deficit, and to some extent should probably let it be. So I think policymakers also have taken that stance,
Yes.
which is very different from what they took a year ago.
Very
the same
different.
period, if I recall.
Very different. Dr.
If
Dipali
you recall,
Joshi.
between October to December,
Yes.
when dollar started appreciating,
Yes.
and that was a dollar problem, not a rupee problem per se. There was no attack on the rupee per se, but we still came out and defended rupee left, right, center. I
That's
remember
true.
between September to December mid.
That's true.
RBI intervened in spot and FX, spot and forward combined to the tune of around almost $100 billion.
But let me quickly ask, since I'm running out of time, Madhavi, just to Dr. Dipali Joshi on the very point you're making, because Dr. Joshi, you said in the past the RBI has not defended a level, but it's true that they've kept the rupee in a narrow band. So this greater volatility that they are trying to kind of ensure. Is it also unsettling foreign investors at a time of all this global uncertainty? This perhaps may not be the right time to take this kind of stance by the RBI?
No. I disagree with you, because you see, as of now, as Madhuri rightly pointed out, it's a trade war. RBI is keeping its powder dry. And RBI knows, and the world knows, because you see the statistics, that we have hefty reserves, we have a currency stabilization account. We can move in with our heavy artillery at any point. We are deliberately not doing it. You stick us with a whammy of 50% tariffs plus 25% on the oil we import from Russia, and you know that we are painted into a corner because we need that oil, and we'll have to pay for a discount or no discount.
Yes.
And so at this point in time, export competitiveness is very important for us. Our exporters, if they benefit from the fall of the rupee, and if the rupee is overvalued and is hurting us and is causing pain, this is the absolutely correct strategy for the RBI to follow and say, show us what you've got.
Fair enough. But
bring it down, we are not coming in.
Yes, but 91 to the dollar clearly is not just a currency move. It's a macro signal, a signal of, yes, there is global stress. There are heavy capital outflows, shifting central bank priorities as well. So a clear message that the RBI is no longer defending comfort levels. They are defending stability. So the bigger question now is not whether the rupee weakens. It's how far, how fast, and at what cost it's going to happen to growth, to inflation, to investor confidence. All of that is very important. But many thanks to our panelists for joining us. Anindya Banerjee, Subramanian Sharma, Dr. Dipali Joshi, Madhvi Arora, thank you very much for your insights, and we'll keep the discussions on the trajectory of the Indian currency. And that's our discussion tonight. But of course, it would bother to see the Indian rupee fall to the levels it has. Today, it's hit $91. 91 to the US dollar. Where it goes next is something that we are watching very closely, and the impact this is going to have on the Indian economy, considering global stresses and, of course, the overhang of the India-US trade deal. With that, we'll wrap it up on this edition of The Big Question. I'm Vikram Oza from me and the team. Good evening.